And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show, Financial Fitness Friday edition. Hope everybody's off to a great start to the day this morning. I'm Danny Ratliff here with John Penn. A lot to get into today. Today is Jobs Day. Everybody is on pins and needles waiting to see what is going to happen here with these numbers. Expectations are for 250,000 jobs this month. Keep in mind, I know we keep hearing information. Are we in a recession? No, we're not. Yes, we are. What is the definition? Nobody knows. It keeps changing as well. But these numbers are calculated at the beginning of each month. And I think these are going to begin to change as we've been talking about this week. We're beginning to see more and more companies out that are announcing layoffs, freezes in hiring. I think this is something that we can expect here for a little bit of time. Market futures are mixed at the moment, finished mixed yesterday. Yields are slightly up as awaiting these new numbers. But big information coming overnight. The Inflation Reduction Act looks like it has all Democratic votes that they needed. Joe Manchin last week announces that he's going to come in and he's for the bill with some slight changes. Senator Kristen Sinema she is on board as the new overnight information. So the big question is, does this actually reduce inflation? And, it's really what's in a name. And unfortunately, it looks like Congressional Budget Office is suggesting that it likely doesn't. We're seeing that, the big things that are within this bill are probably going to move the needle very, very little. In fact, it actually looks like it could increase inflation for the first year or two. And then we should see it subside over time. So it's calling for quite a bit new spending. Now, granted, this is not President Biden's Build Back Better plan, but it does have a few elements of it within here. And so what does this mean and what can we expect from it? One of the big things that they're pushing is creation of a 15% corporate minimum tax rate. So this is going to be for any corporations that make over $1 billion in profits. They want to ensure that they're going to have a 15% tax rate. Prescription drug price reform. I think this could be a great thing. We see these prices soar. John, you and I talk to people on a regular basis that, we look at healthcare expenses, and this is a big problem.
It is.
But and we pay for most of the research here domestically, unfortunately, where other countries are getting, much better deals on this. So this is something I think that, everybody's for. We want to see better things there, better pricing. IRS tax enforcement. I wish they'd just simplify the tax code.
Yeah. Well, I don't think we'll see that in our lifetime.
No, likely not. So one of the bigger things was the closure of the carried interest loophole. And it looks like that may be something that Kristen Sinema is saying, hey, she doesn't want in the bill. They want to treat that independently. And the big thing is that the energy security and climate change investments, a lot of money going towards that. Affordable Care Act subsidy, continuing that. And so I think that, what we should expect from this, it was one of these bills that we thought, they're not going to be able to get the votes to it. They've made enough concessions that it looks like it may actually get done. They're going to introduce it again tomorrow before the Senate. We'll see where this goes, how this ends up, but it's likely going to have little to no impact on actual inflation. And just like we see most of these bills, it's really whatever the hot topic of the day is. That's what they're going to talk about. So today, we're going to talk a little bit about that. We talked a lot about inflation. Go to our YouTube channel, The Real Investment Show. We actually did our webinar on Inflation Nation yesterday, 9 tips on how you can survive and better manage inflation. As we know, everybody's dealing with it right now. We've talked about people's changing travel plans. What are you guys doing to keep more money in your pocket? Because, we look at retail sales, we look at all these numbers, and, from a monetary perspective, a lot of these things haven't changed much. But what you can actually purchase is drastically different.
Yeah, I've seen a lot of people either postpone, delay, or kind of ratchet back their travel plans for the year, what they were going to originally spend on travel. They're really ratcheting that budget back to keep that money aside for other priorities or other things that they just need around their household. So, it's affecting everybody, Danny.
It is. And so hopefully we can find some way or some way to remediate some of these things. It looks like over time we should be seeing these things come down. I would expect to see inflation get a little bit lower. But, even within this Inflation Reduction Act, from an energy perspective, there's an increase on potential gas tax.
Right.
It's like, wait a second, did you not know where that comes from? Do you remember what the impact of this is, especially for people down here in the South? Here in Houston in particular, we drive a lot. We don't have mass transportation like many places do. It requires us to get in the car and go.
Yeah, and to your point, will this Inflation Reduction Act really reduce inflation? You were talking a little bit about the carried interest provision where they want to extend, the holding period on carried interest from 3 years to 5 years, to where if you can hold on to it for at least 5 years before you sell, that's when you would get more favorable tax treatment on
Correct.
that. And I can see why they're looking at trying to kind of close that loophole within carried interest because, in the mid 90s, private equity funds, there's about $100 billion in private equity funds. And that's where you see a lot of that carried interest. Well, now there's over, $4 trillion
That's a big
in
difference.
private equity. But the issue is with a lot of those private funds that are holding investments where they hold property or they hold real estate, a lot of these funds already are owning those particular investments well over for 3 years. So I don't know. I don't see the whole carried interest, provision really adding a lot to the bottom line.
Well, I think the bigger part is that, especially if you're going after corporations, look, this is going to be a tax on everyone in one way or another. And here's the thing that the bigger part of this is that if corporations are paying more in taxes, that's more money out of their pockets, more money off their profits, which essentially is going to impact the workers. So it's going to impact the middle class. Who's going to be hurt the most by this? And so, we're in a time that's interesting. We just saw credit card debt balances at record highs. We're looking at highs over what we saw in 2008. When we had a significant problem, when we had a real recession, many layoffs, much more than what we've seen today. And we're already seeing this record debt level. That's not a good sign. So people are instead of saying, hey, we're going to batten down the hatches, like you mentioned, that you're talking to people who are saying, hey, we're going to reduce spending, we're going to find other alternatives. These people are saying, we're just going to put it on debt. And we know the numbers of what people are spending on an annualized basis just to maintain their lifestyle. Well, guess what? It's gotten a lot higher. And if you're going to raise taxes, on corporations, it's going to have that indirect consequence. And this is not something you do in a recession from a tax perspective. I can't see this working out well in that aspect.
Yeah, I feel the same way, and I just know higher rates are. You were talking about credit card debt and how that's affecting families, and maybe a lot of folks don't realize what their rates are at or how they're adjusting. If folks are continuing to use debt, I know if I see my interest rates on my credit cards going up higher, if I'm carrying a lot of credit card debt, I want to get that paid off as fast as I can. A lot of the folks that we work with, they use credit cards very wisely. They use it to take care of all of their expenditures every month, and they pay it off by the end of the month, so they don't pay that interest, and they use that as really as a budgeting tool. But higher rates is affecting everybody, just even higher mortgage rates. Our oldest daughter had an internship this summer at a mortgage financing company, and in the month of July, they had less than 5 or 6 requests.
Wow.
And now they're having to reduce hours just because the demand is so slow.
Well, you imagine, I mean, to refinance right now, it doesn't make sense for many people if we've seen the rates so low for so long. No expectations, we'll see where these things go. We're talking about that and more. Get back to 8 things you need to know about retirement. What type of accounts do you use? So you listen to The Real Investment Show. We'll be right back after this quick break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the Real Investment Show, Financial Fitness Friday. I'm Danny Ratliff here with John Penn. So, a lot to get into today. We've been getting a lot of questions. You know, we're here in Q3. First half of the year is done. Getting almost back to school, which...
Thank goodness.
Yes, thank goodness.
Sorry, couldn't help it.
No. I think everybody who's at home, homemakers, husbands, wives, everybody alike is screaming, screams of joy.
Yes, it's kind of bittersweet. It's all the back to school expenses, books, and all those good things. But at the same time, it's time.
You know, it's interesting. I think summer has become a lot shorter than what it used to be when we were growing up. And school supplies have gotten a heck of a lot more expensive. And I know it's probably a little bit of the inflation aspect, but the things they require them to get and do, it's through the roof. I mean, I'm like, man, we're going to have to take a truckload just to drop off for the three of them in our house just to get their stuff up there. I mean, and bring a couple, trailers and trailers.
Yeah. Our both of our kids are a little older, so they're both in college. Our oldest is going to start her senior year this year. Can I get an amen on that? So, and just looking at school supplies and books, and they actually, both of our girls, were very fortunate. They kind of watch the bottom line and what they spend on their school expenses. If they have to buy books outright, it's not like the old days where I had to actually buy a textbook or textbooks and haul them to class when I was in school. Now everything is really online, or they can buy kind of an ebook, and it's at least the books are a little bit more reasonable in that regard.
Yeah,
right?
that's
So you
gotta
do
be
save a
nice.
little bit there, but everything else is through
I
the
remember
roof.
we were buying used books.
Oh,
You'd
yeah.
try to find the cheapest ones, and you'd sell them back. And
Oh, I remember just so I could have gas money to come home. At the end of the semester, I would go sell my books back, and man, I felt great having $75 or $100 in my pocket.
that's right. The sad thing is, you probably bought it for $200 or $300
I
bucks.
did.
That book, it's been used for 10 years.
Yeah.
Yeah, that's the way it goes. But so you're talking about kids and really anybody in general. This is when we start looking at, okay, getting towards the end of the year, how are we doing on finances? Where are you putting funds? And what type of accounts can you use? And I think this is one of the bigger parts. And so I want to spend a little bit of time just talking about what types of IRAs, retirement accounts, what is out there and how or when you should use them. And unfortunately, there's so much information and there's so many different avenues that you can look at that we find out many times, John, that they're not being used properly. There's misinformation, or we just don't know what we can do.
Right.
And benefits go unused. And so let's talk a little bit about, let's start with just the basics, right? A traditional IRA and a Roth IRA. Break down the differences for us and tell us a little bit about each one and why you'd want to use it.
Well, sure. Well, one, in order to be able to contribute to either a traditional IRA or a Roth IRA, one, you have to have earned income, right? So first of all, you have to have earned income. And so with a traditional IRA, when you make your contribution to a traditional IRA, then you can typically deduct that contribution. It's a deductible contribution to a traditional IRA. And then when you put that money into the traditional IRA, all of the growth, everything that it earns, it grows tax deferred. And then later in life, when you have to start taking money out of that traditional IRA, especially when the current age is when you're 72 years young, you have to take what is called a required minimum distribution. That is when you pay the tax on those distributions coming out. Or if you take distributions out before then, if you take any money out before 59 and a half, there may be a 10% early withdrawal penalty on that. There are some exceptions, which we can get into here in a little bit. With a Roth IRA, when you make a contribution to a Roth, it's not a deductible contribution. You're putting after-tax dollars. You've already paid taxes on that money that goes into the Roth IRA. But then once the money's in the Roth, all the growth, everything that it earns, dividends, interest, et cetera, whenever the money comes out later in life, it's all tax-free. And there is not a requirement to take money out of a Roth IRA when you are 72. So actually, the money can stay in the Roth throughout your lifetime and continue to grow tax-free. Now, but there are issues, though. Not everybody can qualify to contribute to a Roth IRA, right, Danny?
That's right. So this is an area where you want to start looking at income because you can be phased out depending on how much money you make. So if you're single, you make between $129,000 and $144,000. You're going at $129,000, you'll begin to just only be able to contribute a smaller amount. And there's a formula for that. We're not going to get into that and bore you with that here on air today. And then if you make over $144,000, you cannot contribute at all to the Roth IRA. So a lot of people may say, hey, you know what? I make too much money. I cannot use it. Now, if you're married filing jointly, that number starts at $204,000 and goes to $214,000. So these are things to keep in mind, and you want to make sure that you're aware of what the income looks like for you and your spouse, and understand what your limitations may or may not be. Now, if you contribute too much throughout the year, you can do recharacterization, pull those funds out. However, if you do a Roth conversion, which we have a lot of people who are doing those, and especially getting towards the end of the year, we're certainly looking at these quite a bit more. This is something you cannot recharacterize a Roth conversion. So understand they're two different things. The other caveat with the traditional IRA is that if you're not covered by a workplace retirement plan, so you don't have a 401k, there are no income limitations. You can put funds aside and utilize this and get a tax deductible contribution. Now, the caveat is you can always contribute to one, but you may not be able to deduct your contributions to the account. And then you'll have to keep up with that year after year and actually file an IRS form, which can be problematic because each and every year you're going to have to calculate what your contributions that were after tax into that traditional IRA. So historically, if somebody's going to do that, we would say, hey, if you have pre-tax and after-tax, let's create two separate accounts, keep them completely separate, and make your accounting a little bit easier.
That's right. Yeah. So to your point, you can, as long as you have the earned income, you can always make a contribution to a traditional IRA. The question is whether if you're covered by a qualified plan, or maybe if you're married and maybe you're not covered by a qualified plan, but your spouse is, then there's some income limitations there where you're contribution to that traditional IRA may not be fully deductible, or you may not be able to deduct it at all. Something around this whole, kind of this area of Roths. Sorry, I know I'm bouncing around here a little bit here, Danny, but sometimes there's a lot of confusion around, well, I make too much money, so I know I can't contribute to a Roth IRA. So, John, I hear this a lot. Well, John, I make too much money. I can't convert to a Roth. I can't convert money from my traditional IRA to my Roth IRA. And that is not true. It does not matter. It doesn't matter what your income is. It doesn't matter what your AGI is. You can convert assets from your traditional IRA to your Roth. It's just when that conversion occurs, that becomes taxable income.
Well, that's right. You need to be mindful of a couple of things. You need to be mindful of what your AGI is. Mm-hmm. How old you are. What are you near Medicare age, near 65? Because there's a 2-year look back period that they could adjust your Medicare premiums up if you have too much earned income. And so we want to be very deliberate as far as when we make these types of conversions. But there is no income limitation on a conversion. Now, granted, if you're in a very, very high tax bracket, we may be able to make an argument that maybe it's not the best thing for you to do.
Right.
And so many times we may say, hey, skip it this year. Next year looks better. Or we think taxes are going to go through the roof. And I do have some clients that say, hey, I'm going to get as much out of here. I know I'm making a lot of money. I want to get as much out of these types of accounts as I can, because I think regardless of how much money I make, we're going to see income taxes go way up. And so some people may be more inclined to be more aggressive in that type of environment, or that mindset that taxes are going to increase. And look, I think we're seeing it today. The Inflation Reduction Act, there's going to be some ways that taxes will likely increase there. There's many other pieces of legislation out there that are suggesting we will see higher taxes. If we look at the spending that the government does, I mean, if you and I spent money like they did, we'd be in trouble. In fact, a lot of people are. I mean, look at credit card debt.
Yeah.
But these are things that you need to think about, and this is what's important. So, another thing I think that is easily overlooked, John, is that how many times have you had somebody say, you know what, I make too much money for the Roth IRA. I can't put money into the Roth 401k either.
You're reading my mind.
Because they get them confused, right? They think it's the same thing, but you can with the Roth 401k.
That's right. Yeah. So, and we're seeing more employers offer a Roth 401k option within plans. It used to be that a Roth 401k was, kind of, what is that? I've never heard of that before. It's becoming a little bit more mainstream. Not every employer offers it, but we're seeing more of it where you have the ability to contribute pre-tax dollars to a traditional 401k plan, or you can contribute after-tax dollars to a Roth 401k. And you're right, Danny. I hear a lot that, hey, I make too much money. My spouse and I, our AGI, our combined AGI is too high. I can't put money into a Roth IRA. I'm not allowed. So therefore, I'm not able to contribute to my Roth 401k. And that is not the case. It does not matter what your AGI is. If you have a Roth 401k option available to you through your employer, by all means, you can contribute to that.
Yep, and I think that's something that many people need to take advantage of. And so keep in mind, any of the matching contributions that your employer will give you will still go to your pre-tax. There has been talk and actually discussions and new legislation there that they can potentially use that or move those funds towards paying off student loan debt, put those funds towards a Roth. I mean, we may see some changes come with that, but for the time being, this is something that I think, go and look. And a lot of times it's not as easy to find as you would think. When you go open up your 401k, can you do after-tax or pre-tax contributions? Many people just don't know it's there. They said it and forgot it years ago. And I would make those changes. I also encourage you, if you're using a 401k and you're not going to go in there on a regular basis, make sure that you're going in and you're putting that it increases at least by that 1%. Many plans will now offer the ability to say, hey, each year you're going to increase your contribution by 1%. I think that's an easy thing to do. You see a slight reduction in pay if you're doing pre-tax. It's not a whole lot. It's very, very little as far as the big difference. And I think that's one way that people can kind of get ahead of this big retirement curve that people have.
Yeah, it's sometimes you look at the number, you say, how much do you really need to have set aside to have a comfortable retirement? And sometimes that number can be very overwhelming. And to Danny's point, if you can just start now and just kind of set those contributions to increase on a regular basis, kind of put that on autopilot, the difference every year isn't that noticeable, but in the long run, it really adds up.
That's right. Hey, you're listening to The Real Investment Show. Go check us out on YouTube. Click the like button. We're going to be right back, finish up this conversation on retirement plans, what you can and can't do. You're listening to The Real Investment Show. We'll be back after this break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Mexico is now upset. There's been like 1.5 million people, a lot of them from California, have now moved to Mexico City because of cheaper rent. Now Mexico City is getting very upset because they don't like the impact on their culture.
The Real Investment Show podcast.
Mexico City is getting very upset with the immigration and they want to stop it.
Don't American by Mexico.
Exactly.
At realinvestmentadvice.com.
It's like, stop it.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn, talking about where you should and maybe shouldn't put funds. What are the retirement options out there for you? And so talked a little bit about just the basics, traditional IRA versus Roth IRA, how you can contribute to 401ks. There's a lot of different options out there, but I want to just go back just a tad bit and talk a little bit more about what are the limitations, right? So with inside, if you can, and understanding we've already talked about income limitations and income limitations on tax deductions or even being able to contribute. For a traditional or a Roth IRA, if you're under 50, you can contribute $6,000. If you're over 50, you have a $1,000 catch-up provision. Now within your 401k, it's very similar in the sense that you can contribute a little bit more once you reach the age of 50. However, the income that you can put aside is much higher. So you can put aside $20,500 inside that 401k for 2022 if you're under 50. Now you get a $6,500 catch-up provision for those 50 and older, making that $27,000 that you could set aside. I think it's really important to understand You can contribute. If you have the Roth, there are no income limitations. Make sure that you understand, where you think you may be in the future. And keep in mind, there's many times we visit with a lot of different people that they've never been told about Medicare premium surcharges. They've never been told about Social Security being taxable and what the impact is. So our goal is, as we visit with people, is trying to determine where are some of the best places you can put funds aside. And it may be a little counterintuitive to what the 401k or retirement industry has told us year after year after year, in the sense of put everything pre-tax. And it may be a conspiracy theory, but we've talked about this on the show before on Fridays that, hey, they want to get as much money in those accounts as they can. But we want to keep as much money in your pocket as we can. And so a lot of this is going to sound counterintuitive from time to time, like a Roth conversion. Why would I pay taxes now when I can defer them till later? Well, we don't know what they're going to do with taxes. I would suggest they're going to raise them. We also know that at age 72, they're going to require you to start taking distributions. And if you want to retain any type of flexibility from a taxation standpoint, you need funds in other areas and other buckets that you can pull from that are going to give you a little bit more tax flexibility and leeway. And if everything we have is inside that pre-tax bucket, everything you pull out is taxable. And the way I always equate this is, and John, you've probably heard me say this too many times, but you have to think of every one of these deferred compensation accounts, any of the 403B, 457, 401k, anything that you're putting these funds in to be pre-tax. It is a business partnership between you and Uncle Sam. And it's a unique one in the sense that they can always change how much they own. So I don't like that. I want to make sure that I can keep more money in my pocket and your pocket. And that's the key all along the way. So that's why we think these types of conversations are really important.
I agree. Yeah, and it's not uncommon for individuals that we work with or that we're introduced to. They're great savers, Danny, but they've really been kind of trained, or nobody's really educated them on, hey, maybe does it make sense to put some money in an after-tax or make some after-tax contributions to a Roth, or if they weren't able to, does it make sense to go ahead and convert? And again, nobody knows what the future holds, but do we think income taxes are going to be less in the future? Probably not. So yes, if you convert money today, you have to look at the numbers, see if it just even makes sense. But if you convert money from a traditional IRA to a Roth, yes, you have to pay taxes today. But at least you're paying at today's rates, which are known. I mean, who knows what the future holds? And, Danny, you brought up a great point earlier with, every time you take a distribution out of a traditional IRA, that's all taxable income. That is all part of the calculation as far as what you pay for your Medicare Part B, Part D premiums. That affects how your Social Security is taxed. So it's nice if it's one thing to have a diversified portfolio or a diversified investment strategy. You want to have a diversification of accounts. So that way, as you do get older, you have different accounts that you can pull from selectively to help manage your taxes in a more efficient manner.
Yeah, that's exactly right. So that's the point. Some other questions we've been getting is that what if I set up multiple accounts? What's the impact there? And this is where people can get in trouble because they say, well, look, I'm going to go set up a traditional IRA here. I'm going to set one at XYZ Bank, ABC Bank, and we're going to go and we're going to make the contribution everywhere. And this can really create an issue.
Yeah, it can. So you even if you have 10 IRAs out there, the maximum that you could put in, your total contribution amongst those 10, if you're under 50, is $6,000. If you're over 50, you have that catch-up clause where you can put in an additional $1,000. So you're capped at $7,000. So your total contribution across all those various IRAs cannot exceed that limit.
Yep, that's exactly right. So another big thing that we hear is that, okay, well, I'm going to put funds aside, but I plan on retiring way earlier than 59 and a half. So keep in mind with these accounts, if you're in a traditional IRA, funds do have to remain in the account up until 59 and a half to avoid a 10% penalty plus paying taxes on these funds. Now, if you're in a Roth IRA, you have a 5-year limitation as well, where the funds have to season for at least 5 years. So once you make that contribution, you need to let these funds sit in the account for 5 years before you start taking distributions of any earnings to avoid a penalty plus tax on those earnings. So that's another important caveat. Now, there is an exception to the rule when it comes to traditional IRAs or 401ks and how you can make distributions from them. So it's called it's a tax provision 72T. Mm-hmm. And this is one thing that, I'm seeing more and more people utilize. Seems like, especially with the pandemic, John, people have said, hey, take this job and shove it. I'm going to retire. But there's some stipulations surrounding that as well.
Yeah, it's 72T, or it's called substantial equal payments.
Yep.
And so it's a way where you can have your IRA account, the pool of funds within the IRA. There's calculations involved to basically, generate, a monthly income stream where you're taking distributions out of the traditional IRA prior to being 59 and a half. Now, yes, when those distributions come out, they are taxable. It is considered taxable income, but you don't have to pay the 10% early withdrawal penalty, and you have to maintain the flow of those substantial of those 72T payments until you're at least 59 and a half or 5 years, whichever is greater.
Yes, that 5-year number seems to be pretty prevalent. So keep in mind, as far as how you're going to make distributions is very important. You do need to make sure, and this is another reason why we suggest not putting everything that you have inside of these retirement accounts. Now, we get a question a lot of times is that I want to leave a big legacy. And this has changed because we used to be able to stretch these IRAs out. That's no longer the case. So there's a new law that says you have to take distributions within a 10-year time frame. In fact, Lance and I talked about this on Wednesday, that it was a 10-year time frame. Legislation and guidance from last year, they said, hey, it doesn't matter when you take it. Used to be you could take it over your life expectancy, depending on if the heir had already begun taking their required minimum distributions or not. If you're in a non-spousal IRA, so assuming you want to leave these funds to your children, because if you pass, your spouse gets it automatically, just as it's their own funds, no big deal. But if both of you were to pass, or you were to pass and leave it to a non-spouse beneficiary, now there's a 10-year window they have to take the funds out. And as of just recently, the IRS is now saying that, well, we're going to change how we want you to take these distributions. Instead of it just being any time within a 10-year time frame, now there's going to be a formula for that it's going to be what a nightmare to have to go back and try to figure this out.
Yeah, it's more of an annual distribution.
It is going to be annual.
Yeah, because it used to read that the money had to come out by the end of the 10th year. Well, and if you wait until if you inherit a traditional IRA, and if let's say you keep the money in that inherited traditional IRA and you don't take it all out until the end of the 10th year, you're taking out one big chunk, one big lump sum, and that's all going to be taxable at that period of time. But now you may actually need to take a distribution, a required minimum distribution from your inherited IRA if you're a non-spouse. And you may need to take a distribution out every year. And there have been a couple of folks lately, Danny, that I visited with who unfortunately their mom or their dad passed away. And their dad was of the age where maybe they were in their mid to late 80s and they were already taking their required minimum distributions. But they hadn't taken the required minimum distribution yet for 2022 because you have up until the end of the year to take it out for this year. Well, the account owner passed away without taking their RMD yet, so now the non-spouse beneficiary that's inheriting that IRA, they have to take out 2 required minimum distributions this year. One that their parent didn't take yet, and then one that they have to take out for being the non-spouse beneficiary. So that's 2 distributions that they have to pay the tax on.
That's right. And you have to keep in mind, even if your spouse passes and they haven't taken the RMD, that required minimum distribution, you will still have to take that out of their account. If you have an account of your own, you'll have to take it all out at the same time. And so it's easy because you have some multiple balls in the air, and it's really important to understand that get your ducks in a row, understand where everything is, understand the implications of it. Meet with your advisor. And I think this is really an important thing. We have a lot of clients that will come to us and say, look, we're very good at managing money. However, I know I'm getting older. I know that if something were to happen to me, I want my spouse to be taken care of. So I want to work with an advisor who has similar goals, philosophies, and who can articulate these things and also help in the event something were to happen.
Yeah.
And so, unfortunately, you do this long enough, you get a lot of experience with this. And so we go through, quite a bit of these scenarios over time. And, it's never fun, but it is something that I think is really needed. Another thing, update your beneficiaries, guys.
Yes.
How many times do you see it, John, where just nobody has a beneficiary down, or it's the wrong beneficiary, the beneficiary's passed. And you want to talk about creating headaches when somebody passes? That is probably headache number 1.
Saw that this week.
Yeah?
beneficiaries on one account, but not designated on the other.
Oh, man,
Very
so
common.
important. We'll talk about this. We're going to finish up this conversation when we get back. Hey, check us out on YouTube, Real Investment Advice. Go to realinvestmentadvice.com. Newsletters come out every weekend, every day, daily commentary. We'll be right back after this quick break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to Financial Fitness Friday of the Real Investment Show. I'm Danny Ratliff here with John Penn. So, had a long conversation about different types of retirement accounts, what you should be doing. You know, are you updating beneficiaries? Or do you understand taxation, income limitations? I mean, so many things and so many variables with this, and I think it's easy to overlook. Or not even have these types of conversations. And so keep in mind when we're talking about this that it may not pertain to each and every one of you. And some of you guys may be business owners and maybe you have other avenues. And that is one thing that we do specialize here at RIA is understanding different types of accounts, what you should be doing to minimize or, prevent taxes in the future. And so the goal is to keep as much money in your pocket as possible. So there are other options. If you're a business owner, you could look at a SEP, a simplified employee pension plan. If you're a small business, generally that's a really good account for somebody who does not have a lot of W-2 employees. Maybe they're 1099, or you're just a mom and pop shop and it's just the two of you or family. Simple IRAs are another good avenue. So, a SEP and a simple IRA, you can put a little bit more aside than you can with your other types of accounts. Limitations are very similar to on a SEP. They're similar to a what you can do for a 401k, all in with employer contributions as well. A simple, you can put up to $14,000. You have a 3% contribution for employees. But, we just always have to be mindful of the different caveats. We also do a lot of 401ks, profit sharing plans, defined benefit plans for somebody who's out there making a lot, wanting to put aside as much as possible. So lots of different avenues and alternatives and things that you can do. I think that, understanding what best suits you is really important. And then not only that, but understanding, okay, how do you invest for the time frame that we're in, or the time horizon that you may have, that can change for a lot of different people. So what are other big questions you get about retirement accounts, John? I mean, I know there's so many different things that people look at, and you're probably getting a lot every day.
Yeah, or just, common question that I've been getting a lot of too is, sometimes with a married couple, let's say one of the spouses is, has earned income and is out there, working, and the other is, probably doing most of the work, taking care of the household and taking care of the kids. They probably don't have actual, quote unquote, earned income, but they probably have the more stressful job with running the household. Well, if for with a married couple, if one spouse has earned income and the other one does not, the spouse with the earned income can make a spousal contribution for, let's say, for the IRA of your wife or husband, whoever, whichever party that is. So you can make a spousal contribution to an IRA. So if you're under 50, one is working, one is not, you can still put $6,000 into an IRA for yourself, and you can put $6,000 into an IRA for your spouse. Or if you're over 50, you can do a total of $14,000, $7,000 a piece. So sometimes we see that, and so get a lot of questions around that too, Danny.
Yeah, I think that's a really good point. I think that, that's important to know, understanding that if you can contribute, if your spouse is still working or has access to a 401k or some type of retirement plan. What about, we talked a little bit about RMDs and what that looks like. I think it's important to understand how those need to be taken and when, because that's a lot of times often overlooked, especially there's been a lot of changes. We went from 70 and a half just recently to 72. There was a graduation period. Now we're talking about going to 72 to 75 potentially. Nothing has been passed on that, but there has been quite a bit of talk. Another thing that I think is really important is, Social Security. How do you take that surrounding this? How do you bridge that time and hopefully defer and delay, and then keep as much money, long term? I think people overlook that. We're talking about spouses and how do you contribute, but also how do you take these benefits over time to make sure that you get the most? And unfortunately, when we talk about Social Security, we see a lot of times people take it way too early.
Too early.
And it impacts them. You take a discount as far as what you would get from your primary insurance amount, which is the amount you get at full retirement age. And then you have to think, if you're the breadwinner and you took it early, well, your spouse, if you pass, is going to get a significantly reduced benefit as well. And so you don't always get as much as you can out of it, especially if you live long. So now there are times if you have a terminal illness, you have something that's, you're just not in great health, you need the money. I mean, sometimes you have to take it. But a lot of times people don't realize that they take it early, then they have other income, and it offsets. They have benefits withheld, so now they have a reduced benefit altogether, and you're paying it all back. I mean, that's something that we see a lot, just because they say, I'm getting every dollar that I can out of it. So that's something that we do as well as Social Security maximization. And so understanding, what does that look like for you long term? What are some of the things out there that you need to be mindful of, and how do you keep as much there, get as much out of the system as you can? And so we hear a lot of these things, and we talk about how sometimes people are taken advantage of with really slick marketing, right? Social Security is going away. Look, yeah, it's going to change, right? We all hear the numbers. I mean, we've heard the numbers that, it's going to be reduced year after year. Congressional Budget Office comes out, the Social Security Trust comes out and says, hey, we can go until XYZ year. And right now it's till 2035 with about a 20% reduction in benefits. They're going to have to make changes. It's not going to be popular, just like most of these bills. But it'll be subtle changes over time that I think will be beneficial. But, we hear a lot about, you can invest. You hear a lot on the radio ads as well. Well, you can invest and never lose money. And you hear about a lot of different avenues and things that people can do. Tell maybe walk us through a little bit about what you see out there, John.
Yeah, just investment scams or folks even just trying to steal your identity. But just from an investment scam standpoint, it's stats are out there where 1 out of every 10 of us are going to be subject to some sort of a scam or scheme at some point in our life. Unfortunately, the folks that are usually targeted the most are the elderly. Right, especially right now, because yes, short-term interest rates are rising. You're starting to see some higher rates on things like some short-term cash alternative CDs, individual treasuries. But in a low interest rate environment, when it's really hard for folks to find income, folks know that usually it's the elderly out there that need income, or they're looking for something to help them with create income with their investment portfolio. So they are typically targeted for investment scams more than most. So you have to just watch out and just be on alert, because folks are pretty crafty with how they're trying to get information to you, or take your information, or just to get your funds. And so you have to kind of put your guard up a little bit. And if something is just too good to be true, it probably is. But usually these investment scams come across as guaranteeing higher returns, that maybe you're if a short-term CD is paying 2.4, 2.75%, and somebody's offering you 5 or 6 or 7, I don't know about that. That's a little egregious there. That's just too good to be true.
Well,
right?
It is, and if it's too good to be true, it likely is. And I've heard of some of these strategies that were going around with crypto that were just like, this doesn't make sense. You're going to do what every single month? You're going to double your money? Well, if that was the case, why wouldn't we all know about it? Why wasn't everybody doing it at the same time? But you make a really good point about the CDs. I can remember back when Alan Stanford was out issuing these CDs at 8 and 9%.
I remember too.
When everybody was at 4 or 5% during that time frame, and Bank of Antigua, and I mean, when you get in this type of environment, that when you start hearing these things, something should trigger and say, okay, maybe something's not right here. And those are probably some of the easier ones. I mean, those are the ones that it's just, I hate to say it, common sense, because I know people that had money there and actually went through this that are very smart, right? It's easy to get caught up in it and say, well, my buddy's done this for years, or my relative, and you know what, it's no big deal. It's okay. Everything's on the up and up. And you know what? Probably most of the time it is, because we only hear about the bad ones. And those are few and far between. But there is a special place for people that take advantage of people like that. I'm not going to say it on air, but you know where I'm going. But that's probably the headline news. There's a lot more to it that I think people very subtly. I mean, we hear about it all the time. Running an investment firm, we hear from people that, hey, my bank account was hacked. They took X amount of money out. We need to make sure that, we stop any transfers to it. We're opening a new account. But sometimes we put ourselves in harm's way by clicking on things we shouldn't.
That's exactly right. I mean, I get emails in my personal email box where it says, hey, fax was delivered. The fax that you were waiting for was delivered. Click here to load your document. I'm like, well, wait a minute. I didn't ask anybody to fax something to me, so there's no way I'm clicking on this. And who knows, if I click on that, then all of a sudden somebody takes over my PC, or they're in there on my hard drive, or who knows what they're trying to do. So just here recently, our youngest daughter, who's starting her sophomore year in college, had an email come through from Apple saying that there was a problem with her account, and that it was overdrawn, or that it was unpaid. And she was looking at it, and she said, Dad, would you come here for it? Because she's home right now. She said, Dad, will you come here and take a look at this email? And it looked really legit. I mean, it had the Apple logo on there, the font, everything was really well done. There was one word in the fine print that was misspelled. Down underneath, your account is overdrawn. And she said, Dad, look at this. And I said, well, let's go. I said, don't click on that. Let's go check your account. And sure enough, she was paid up and it wasn't overdrawn. But if she would have clicked on that link that came through saying that she was unpaid, it was definitely somebody phishing or a hacker or whatever that may be. So, emails and things today look so legit, but if it doesn't seem right when you get it, it probably isn't.
John, I think I get one of those a day. I'm even getting random text messages now, like, hey, click this link. I'm like, no, sir, not today, Satan. And listen, these things happen. It's unfortunate. We'll talk more about these, some of the things you can step up your security, how to protect yourself here. We'll do that next week. But thanks for joining us. This is a Real Investment Show. Hey, please go by the YouTube page. Check us out. Go to realinvestmentadvice.com. Go click on the newsletter. We've got a lot of new events coming up. Can't wait to announce. So y'all stay tuned. Thanks for joining us. Everybody have a safe and happy weekend. We'll see you next week.
Money, must be funny.